So we've been thinking about Johnson& Johnson's merger and acquisition M&A activity for a long time because, as you mentioned, they're sitting on this inflated balance sheet. They've got $18.5 billion in net cash, which means $38.5 billion in cash and marketable securities and $20 billion of debt. They didn't act in 2015, citing that everything is too overvalued, but clearly companies have gotten a lot cheaper at this point.
Yeah, they're going to be selective, though. I mean, if you listen to the conference call, and I think every investor should try to tune into the conference call, or at least read the transcript, scroll through it. CFO Caruso had a couple interesting things to say on that conference call about this cash stockpile. One of the things he said is that it's a higher level of cash than they typically hold. But he also went on to say that they're going to act, and they will act, but they're only going to act when they see the right value in the right deal at the right price with the right partner. So there's a lot of caveats that are going to be associated with any deals that they do. And you and I talked, I think it was last week or the week before, we were talking about how J&J has indicated that they have a preference towards smaller bolt-on acquisitions. Yeah, that's probably where they're likely to focus, especially if they can get, teams that fit that, mantra, if you will, right price, right people.
Yeah, and I'll quote Alex Gorsky, the CEO here. He says, smaller tuck-ins are frankly more straightforward to get done. So that's showing your hand right there. Although immediately after he says that, he does kind of pivot to say that, we do consider bigger acquisitions, but it seemed to be mostly in the consumer segment that they would even think about it.
Yeah. So I mean, I think that investors are going to see that there's going to be money that's going to get spent. But I wouldn't expect any deals that are going to be of such a size where it's going to impede their ability to continue to send money back to shareholders through buybacks, which have been a very important part of the company's capital spending plans, and also dividends, which, Johnson & Johnson is one of the best dividend-paying stocks in existence today.
Yeah, absolutely. And it's a 3.1% dividend, a company with a really, really strong history of paying such a dividend. I don't know about you, Todd, but I am definitely personally bullish on Johnson & Johnson. Probably a good time to remind people that we might have interest in the stocks that we talk about on the show, and The Motley Fool could have formal recommendations for or against them. Don't buy or sell based solely on what you hear. Go read that conference call transcript. But just to wrap up, I mean, this is the closing of the 2015 books for J&J. How are you feeling about the company? Thumbs up, thumbs down?
I'm going to give it a thumbs up. I mean, obviously, they got to figure out how to replace the revenue that's going to get lost from Remicade, but they've got some really interesting drugs that are coming through the pipeline. They've got 70 products in novel drugs that they're studying in early stages of development. They've got a recent filing that they've done for Invokana plus metformin combination therapy that could be a big seller. They recently got a new drug on the market for multiple myeloma. I'm going to give it the thumbs up. I think this is a company that investors can continue to stash away for the next decade. Forget just 1 year.